Hello, everyone. My name is Nathan Corey alongside Dan Brown here at Richardson Capital Management, and we are here today with our economic and investment update for the month of April 2026. Well, Dan, after somewhat disappointing returns in both months of February and March, the stock market came back in a fairly strong way in the month of April, posting fairly robust and broad-based returns for the month. We saw most benchmarks hitting all-time highs throughout the month and again, pretty broad-based positive performance. A question that we've gotten from some clients, and I'm sure most investors are wondering, is kind of what changed during the month of April and how have we been able to overlook some of those risks that we saw in the previous months, namely the Iran conflict, which again still doesn't seem to be resolved, given that we've got no real concrete progress on the peace talks, and we still have the issues with the Strait of Hormuz being closed. What are you seeing in terms of how did April overcome those concerns?
Yeah, I think the best way to explain that to our readers and listeners, Nathan, is to refer to an old Wall Street adage called the wall of worry. So it basically refers to stocks climbing a wall of worry. And if we think about, these worries as kind of like stacks of bricks, we can kind of stack them up. And again, the market tends to climb that wall of worry. And we think that's the best way to explain the positive reaction that we saw in the month of April. So basically, the stock market generally continues to advance during a bull market,
Mhm.
despite some negative headlines and anxiety and reasons that should logically hold the stock market back. But investors kind of tend to take a long-term view on things. And investors are looking through this most recent military conflict with Iran, just like they've looked through other examples in the wall of worry over the past year or so, things like inflation, the government shutdown, supply chain risks, and most recently, again, the Iran conflict.
Mhm.
So just want to remind investors that, over short periods of time, things like sentiment and fundamentals and market reaction don't always jive together.
Got it. And Dan, one of the key data points that we keep an eye on is interest rates and the rate policy as set forth by the Federal Reserve. We had the Fed meeting on April 29th, which to nobody's surprise, they chose to keep rates steady again and made no real significant changes to the outlook for the year. That said, do you have any thoughts on updates that we saw from the Fed?
Yeah, the one update we have is the fact we think that Kevin Warsh is on track to be confirmed to take over as the new Fed chairman, probably in May, by June latest. We definitely think he'll be seated and confirmed for the June meeting. And as far as the actual meeting goes from April, again, as expected, the Fed paused, citing the uncertain effects of higher energy prices on inflation. So Fed will probably be on pause for a while, at least this summer.
And then another significant data point that we like to keep an eye on is corporate earnings. And as we saw through the reporting that's been done so far for Q1, very strong corporate earnings. I think we had about 80% of companies that have reported have beat on both revenue and profit. You want to maybe dig a little bit deeper and give us some updates on the corporate earnings side?
Yeah, so this is the main thing that's been keeping us bullish on the stock market for the better part of like 2 years now. So I know we've talked about this concept, quite a bit. We're going to talk about it one more time here today. So we've got some results that we want to share with you just on the progress of first quarter earnings season. So the first graph that we're showing here is a table for earnings, and basically we see for the overall S&P 500, earnings are so far growing at about a 16% year over year pace, which is a very strong pace. And if we look at this chronologically, it's an interesting trend that we see. So looking back to October, we saw that expectations were for about 12% earnings growth for the first quarter to start the year. That rose to about 14%. And here we are today, and it's about 16%. We think by the time that earnings season is fully completed, that number could grow even a little bit more. So if we look at the 11 economic sectors here, the one that's worth highlighting is technology. So that is the biggest sector by weight within the S&P 500. And look at the earnings growth there, and look at that again. Look at that trend growing from 25% to 36% to current day about 48%. So that's a meaningful part of the index and growing at the fastest pace. We think a lot of that is just due to the build out of the artificial intelligence theme, specifically around semiconductor chips. And we also see a number of other sectors with double digit earnings growth. So it's not just technology that's leading the way here, but nonetheless, it's a very positive story. And the other thing we want to highlight is just the fact that margins or profitability has been improving quite a bit. So the second graph that we're showing here is, a graph going back to 2011. And the thing we want to highlight here is just, it's basically at an all-time high on this graph. So operating margins near 20%. And you can see the meaningful increase the past couple years. Just going back and tracing this pattern, we see a meaningful dip around the COVID pandemic in 2020. And then the economy kind of got back on track, and you saw a pretty meaningful, V-shaped recovery there. And then we had higher interest rates in 2022 and 2023, and naturally, margins took a little leg lower. But then the past couple of years, it's been up and to the right. So again, companies growing earnings last year at a double-digit pace. This year, we think they'll grow at a double-digit pace, and profitability metrics at near an all-time high, near 20%. So all in all, a very good corporate earnings season. And again, this is probably the number one reason why we've remained bullish on the stock market the past couple of years.
Right. So Dan, when we put that all together, it would seem like our, cautiously optimistic outlook that we've had for a while now seems to be intact. And again, to your point, despite the fact that we've got geopolitical concerns and other issues, investors have been kind of climbing that wall of worry, largely being buoyed by the corporate earnings and the strong environment there. So as we look kind of through the rest of the year and going forward, do you see any significant changes to our overall positioning or outlook?
Yeah, for our discretionary managed portfolios, no, not at the moment. In fact, we feel good about the fact how we're positioned currently. In fact, want to remind our readers and listeners that we did not alter our positioning recently with the outbreak of the military conflict in Iran. So we kept our positioning the same. So fairly bullish. We did not get defensive. We felt that we were rewarded for that in the month of April,
Right.
and we feel pretty good about that going forward. The other reasons we remain optimistic, besides the corporate earnings that we talked about, is just we think that the monetary policy with the Federal Reserve is still leaning towards easing.
Mhm.
And then, fiscal policy. So the benefits of the one big beautiful bill, we think for both corporations and consumers are coming true.
Well, with that, we want to thank you for watching. As always, feel free to reach out if you have any questions or concerns, and we sincerely appreciate your continued trust and confidence.